Welcome to the Deep Dive. Today, wow, we're looking at something massive unfolding in the energy world. We're talking Mitsubishi Corporation. Japanese giant, right? Reportedly making its largest acquisition ever, an $8 billion bid for Ethon Energy. That's a U.S. shale and midstream company. Huge number, obviously. But what's really going on here? What does this tell us about Mitsubishi's, long game? Okay, let's try and unpack this.
Yeah, you've really hit the nail on the head there. What's truly interesting, I think, is that this isn't just buying some assets off the shelf. This deal points to something much deeper, a strategic shift. It tells us a lot about Mitsubishi's long-term thinking and how they're positioning themselves for, well, the future of global energy.
Okay, so let's ground ourselves first. The basics. Mitsubishi, massive company, involved in everything. They're reportedly paying $8 billion for Ethon Energy's U.S. shale production and its midstream stuff, pipelines, processing plants, the works. And yeah, biggest deal they've ever done.
Right. And if we connect this to their strategy, it's actually not out of the blue. This lines up almost perfectly with Mitsubishi's corporate strategy 2027, which they announced last year. In that plan, they specifically set aside $1.2 trillion, which, when you know it, is about $8 billion for EX-related investments. That's energy transformation. And they called out upstream gas, LNG. So this looks very deliberate.
Okay, so deliberate execution of a plan. Makes sense. But still, the question remains for a lot of people, I think. Why Ethon specifically? What makes this private U.S. company worth an $8 billion bet, their biggest ever?
Yeah, good question. It really comes down to two things. Ethon's top-tier position in the Haynesville Shale, a key gas basin, and maybe even more importantly, its integrated midstream infrastructure. We're talking over 1,700 miles of pipelines, 9 gas treating facilities, huge capacity, over 3 billion cubic feet a day. That integration gives them a structurally lower operating cost. That's a huge edge.
Right, that integration sounds like the key piece. So what are the direct benefits, the synergies Mitsubishi gets from owning all that?
Oh, they're immense. Think about it this way. Before, Mitsubishi was mostly buying natural gas, like ingredients, on the global market. Now, they own the farm, the processing plant, the delivery trucks, the whole thing.
Full vertical integration.
Exactly. They shift from being just a buyer, a price taker, to being a producer controlling the whole chain. They capture the margin all the way from the wellhead to the point it gets loaded as LNG. And beyond the financials, it gives them huge operational supply security, direct control over nearly 3 BCFD of gas. That massively de-risks their global LNG business. Plus, they get invaluable market intelligence, real-time data.
Okay, so massive deal, strategically crucial. You would think the market would react strongly, right? Big jump or big drop. But Mitsubishi's stock? It barely budged, dipped like 0.3% initially. What does that tell you?
Well, that initial reaction, it's often just, there's a reflexive caution. The market sees a big price tag, thinks about the debt increase immediately, short-term focus. But the longer-term view, I think, is quite positive for Mitsubishi. As investors really digest the financial benefits, the operational security, a positive re-rating is likely. And, for Ethon's backers, the private equity firms, this is a fantastic exit. Probably better than an IPO given market volatility. Perfect timing.
Sounds like a win-win, strategically speaking. Okay, let's zoom out a bit. What are the broader ripples here? What does this mean for, say, global energy flows and especially Japan's energy security concerns?
Yeah, it ties right into that geopolitical chessboard. Japan is constantly focused on energy security. It's paramount for them. Investing heavily in the U.S. like this, it's a prime example of what people are calling friendshoring.
Friendshoring, right.
Building reliable, secure supply chains with stable allies, reducing dependence on maybe less predictable regions.
Makes sense. Secure resources from partners you trust.
Exactly. And look, are there risks? Of course. Big deals always have risks. Commodity prices fluctuate. Integration can be tricky. But Mitsubishi seems to have thought this through. The vertical integration itself is a kind of natural hedge against price swings. And crucially, the plan seems to be retaining Ethon's experienced management team. That minimizes disruption.
So bringing it all together then, what's the big takeaway for you? What does this all signify?
For me, the aha moment is that Mitsubishi isn't just buying gas fields and pipelines. They're buying control. They're buying security. And they're essentially buying a new vertically integrated business model for how they operate in the global energy market. It's a fundamental shift.
Control, security, a new model.
Yeah. And maybe a final thought for you, the listener, to chew on.
This $8 billion deal sets a really high benchmark for valuing these kinds of integrated U.S. natural gas assets. Premium quality, integrated infrastructure. Could this be the first domino? Could it trigger a wave of similar deals? Other global players looking at their own vertical integration? How might that reshape the energy landscape over the next decade or two? Something to think about.